The following financial statements of King Limited for the year ended 30 June 2015 have been presented to you. You have been hired to complete the statement of cash flow for 2015. King extract a statement of profit or loss and other comprehensive income for the year ended 30 June 2015. Comparative figures, revenue, cost of sales, investment income, operating expenses, and interest on long-term loan. King statement of financial position, also for the 2 years, comparative figures. Non-current assets, well, it's only one total, so we assume that they're going to give us more particulars. Inventory, trade receivables, and cash equivalents. Guys, what happens if they do not give us more particulars of what property, plant, and equipment consist of? If that is the case, then you work in one account and you call that account PPE. And the opening balance obviously is going to be whatever the statement of financial position states, and so same apply to the closing balance. And then everything that you should have posted in any cost price PPE account, you're going to post on the debit side of the PPE account, the combined account. Simultaneously, everything that you would have posted on the credit side of the cost account, you would have posted now in this combined account. The same thing applies, whatever you would have posted on the debit or credit side of the accumulated depreciation account, you are going to post in this so-called PPE account. So don't get sidetracked with the fact that we do not give you always the breakdown of property, plant, and equipment. You can still get quite far without that. Okay, then current assets, we had inventory, trade receivables, cash and cash equivalents, and we had share capital, 6% non-cumulative preference shares, retained earnings. You can see there was a movement. 11% debentures, that stayed the same. Long-term borrowings, there's quite a movement. Trade and other payables, SARS income tax payable. No shareholders for dividends. Do you see that? Additional information, 80% of the sales for 2015 were on credit. Now, obviously, we know that we only post to our debtors accounts credit sales. But if we're only going to post 80% to our debtors accounts, and let's say we reconstruct our debtors account and we get the bank figure as it was actually posted to the debtors account, whenever we want to record cash received from customers, cash sales is also cash received from customers. So then all you have to do is you're going to add that cash sales to the amounts received from the debtors. So really, in this question as well, this is a bit of useless information. Included in investment income are dividends received of 10,000 Rand during the year. Let's highlight that. The only other income from outside investments is interest. No dividends were paid or declared during 2015. Important. Okay, let's have a look at investment income. I think they have investment income here, 78,000 Rand. And they say, well, dividends was 10,000 Rand. So obviously here we had dividend income of 10,000 and interest income 68,000. Now remember, on the face of the statement of cash flow, I have to show those two separately. That makes up the 78,000 Rand. Here they give us the breakdown of PPE, costs, accumulated depreciation. The next bullet is all about PPE, equipment. The next bullet is all about the straight line basis, the depreciation method that we're going to apply, and there's a zero residual value. Then on 1 January, this is all about shares, so financing activities. Right, this one, share issue expenses. The policy is to write it off against the share capital account. Remember, you are not allowed to net any gross proceeds with the share issue cost. So you have to show the gross proceeds from the issue of the shares, and you have to show the share issue cost separately as an outflow of cash. Then they only tell you a portion of the 6 non-cumulative preference shares were bought back on 1 April. Then it's all about long-term borrowings. Long-term borrowings of 200,000 was repaid during the year. Some of these borrowings were replaced with new long-term borrowings, of which 10,000 Rand is repayable in 2016, next year, and has been transferred to trade payables. Now that is important because we have to understand that we have to take out here the current year minus 10,000 Rand. That short-term portion of the long-term loan, that is actually part of that balance there, so we might as well add it there, 10,000 Rand. Included in operating expenses is profit on the disposal of vehicle, loss on the disposal of plant, profit on the disposal of equipment, debenture interest, and depreciation. The company tax rate is 28%, and wear and tear is equal to depreciation. Now, as soon as I tell you that bit of news, then it means that I want you to do some kind of tax calc. Prepare the statement of cash flow in accordance with IAS 7 and by using the direct method. No notes, reconciliation, or comparative figures are required. Great, so let's start. Direct method, the first thing that we are interested in is cash received from customers. And what do we need for that figure? Well, there is nothing that happened in the debtors accounts. So it is a bit stupid to go and do a T account and opening and closing, all that kind of rubbish. You can take the shortcut. The revenue for the year was 2,570,000. We are going to adjust that for the accrual principle. So therefore we're also going to account against that revenue the movement in trade receivables. So there was an increase of 19,000 Rand in the debtors balances. So there's our sales 2,570. There was an increase in debtors, so it's a cash outflow of 19,000. So cash received from customers 2,551,000, and we go and park it in our cash flow statement. Let's see, this one is a bit bigger. Cash received from customers 2,551. The next line item is cash paid to suppliers and employees. But before we get there, let's do our PPE accounts first. Why? Because there's a lot of non-cash flow items as well as our investing activities information coming out of those notes. We are going to open up a T account for each and every one of these plant. Cost. Plant at cost will have an opening balance of 2,520 and a closing balance of 3,320,000. Plant and machinery 2,520, closing balance 3,320,000. Vehicles. Cost opening balance would have been 1.2 million, closing balance would have been 530,000. Opening balance 1.2, closing balance 530. Equipment. The opening balance of cost 500,000, closing balance 600,000. 500,000, 600,000. Then accumulated depreciation for plant. That had an opening balance of 1,890 and a closing balance of 2,348. 1,890, 2,348. Vehicles. Opening balance 600,000, closing balance 330,000. 600, 330. And equipment. Opening balance 300,000 and closing balance 117,000. 300,000, 117,000. Okay, now we can start building the puzzle. During the year, plant with a cost of 256,000 and vehicles with a cost of 800,000 and equipment with a cost of 400,000 were sold. So let's transfer all of those costs to their respective asset disposal accounts. So we're going to open up an asset disposal account for plant. And for that plant, we're going to remove out of the cost price 256,000 and we're going to put it to the asset disposal account of plant 256,000. Then for vehicles, a cost of 800,000. So we're going to take the 800,000 out of the vehicle account, cost price, and we're going to put it to the asset disposal account of vehicles. 800,000. It is. It's a little bit, oh, so that looks a bit better. 800,000. Then for equipment, 400,000 is going to be taken out of the cost account, and that is going to be transferred to the asset disposal account there, 400,000 on equipment. The plant had been purchased 2.5 years earlier and was expected to be used for 5 years in the generation of income. So guys, what was the accumulated depreciation? The total lifetime of the asset was 5 years. 2.5 years has already expired. So they also tell me here, all items of property, plant and equipment are written off on the straight line basis over the useful life of the asset to a 0 residual value. So the plant had been purchased 2.5 years earlier and it had a 5 years lifetime. So exactly half of that has been written off as depreciation. So accumulated depreciation plant, 256,000 divided by 5 multiplied by 2.5, or just divided by 2, gives us 128,000, and you're going to drop that down to the asset disposal account. There it is, accumulated depreciation. The vehicles had been purchased 4 years earlier and had an estimated useful life of 8 years at the date of the purchase. Also half of the cost of that vehicles of 800,000. That is the accumulated depreciation on the vehicles sold. So where's our accumulated depreciation on the vehicles? Half of it, 400,000, has been written off already, and that we're going to drop down to the asset disposal account of the vehicles, 400,000. The equipment sold had an accumulated depreciation of 250,000, so that's easy enough. Accumulated depreciation on equipment, 250,000, drop down to the asset disposal account on equipment, 250,000. Now in the question they have told us somewhere what is included in, there was a profit on the disposal of the vehicle of 3,200 rand. So in the asset disposal account, vehicles, profit 3,200. So the proceeds was 403,200. And you can go and park it immediately in your cash flow statement. Cash flow from investing activities. Proceeds on the sale of the vehicles, that was 403,200 rand. Go back to that account. Here's the vehicles proceeds, 403,200 rand, and you can park it. Good. Loss on the disposal of plant, 13,000. So in the asset disposal account of the plant and machinery, on the credit side, loss on the sale, 13,000. So if we're going to balance this account off, we will see that the proceeds was 115,000. So go and park it in your income statement. Proceeds from the sale of plant, 115,000. Profit on the disposal of equipment, 6,800. So in the asset disposal account for equipment on the debit side, profit 6,800, and then by balancing off the account you can determine that the proceeds must have been 156,800. So here it is. Proceeds on the sale of equipment, 156,800. Great. See if there's any more information on PPE. None. So that means we can now balance off our accounts. Plant and machinery. Balancing figure is on the debit side, and that must represent plant and machinery purchase. Well, there was sold, so we might as well assume that that was for replacement purposes. We're going to balance off the vehicles at cost price account, and therefore we're going to need a debit there, and that is going to be additions to vehicles, let's assume also it is for replacement purposes. And the same thing here, if we're going to balance off our equipment at cost account, we're going to need a debit there, and that can only be represented by new equipment that we've bought. So in our cash flow from investing activities, we're going to have plant purchased 1056, vehicles purchased of 130, and equipment purchased of 500. Here it is. And we can all assume, because we've sold some of that stuff, that all of these new assets that we've acquired is for replacement purposes. I'm not done yet. If we go to the accumulated depreciation account, now we're going to need in each and every one of them an entry on the credit side. And what can that only represent? That can only represent depreciation. So depreciation on the plant balancing figure 586, vehicles balancing figure 130, and equipment balancing figure 67,000. And if we add those three together, that one and that one, oops, and this one, it gives us then total depreciation for the year 783,000 rand. Great. Where are we going to use that? Going to use it as a non-cash flow item, and we have to do our cash paid to employees and suppliers. So we might as well go and park that thing. We know that thing starts cash paid to suppliers and employees with profit before tax. We don't know, we haven't seen that as yet. But we know we're going to add back depreciation. And there's our depreciation, 783,000, which we have just calculated there. So guys, you've done the calculation and you go and park it immediately where it should be. Then you will receive all your marks. If you're going to say, I'm going to come back to this later on, number one, you're going to forget. Number two, if you don't, you're going to lose 50% of your marks. Number three, it's a very bad idea. Okay, so we've done that one. Now let's now go full force, and we're going to determine cash paid to suppliers and employees. We're going to start with our profit before tax. Now we don't have anything here. They haven't calculated that for us, but we all have calculators and a healthy mind, so we're going to do that ourselves. You're going to use exactly that same figures to derive at my profit before tax. So you're going to start here at 2570 revenue, cost of sales you're going to deduct, investment income you're going to add, operating expenses you're going to deduct, and interest on the loan you're going to deduct to get to my final profit before tax figure of 295,000. So that is our starting point. Profit before tax, 295,000. What are we going to eliminate first? We're going to eliminate non-cash flow items. We've already eliminated depreciation. We're also going to eliminate profit on the disposal of vehicle, loss on the disposal of plant, and profit on the disposal of equipment. Then we want to eliminate all separately disclosable items, which will then be the debenture interest of 5,500, depreciation we've dealt with already, and they had a long sing-song and dance here about dividend income and interest income. So that dividend income of 10,000 Rand and interest income of 68,000 Rand, that is also separately disclosable items, so we have to take that out. Dividends received 10,000, interest received 68,000. Profit on the disposal, here I've added together the 3,200 and 6,800, which gives us 10,000 Rand. And yeah, that was a non-disclosable item still. So here is, and then don't forget about revenue, because we're talking here about cash paid. So this is our expenses converted into cash. So therefore we have to take out our revenue figure. And they gave us our revenue figure, that's our sales figure, that was 2570. Great. What have we now calculated? We have now calculated all other expenses accounted for in the income statement, of which there was somewhere underlying cash flow involved. what we want to do now is we want to convert those expenses, which was recorded based on the accrual principle. We want to take out the impact of the accrual principle because that doesn't represent cash flow. So we're going to start with those expenses, the 153,500, 153,500. We're going to adjust that with our decrease in inventory, because that's the first item that actually pertains to expenses. So there was a decrease in inventory, and that represents an increase in cash, 29,000 Rand. Then trade payables. Now remember, included in the 120,000 was 10,000, which was the short-term portion of the long-term loan. So we cannot work with 120,000, we will work with 110,000 opposed to 85,000. So our trade creditors increased from 85,000 to 110,000. And that gives us an increase of 25,000, which also represents an inflow of cash. Expenses is an outflow, therefore it must be in brackets. So cash paid to suppliers and employees, 147,500, and we're going to park that on the face of our statement of cash flow, 147,500. And then the difference between those two gives us net cash generated by operations. Do they want us to do the reconciliation note? No notes, reconciliation, or comparative figures are required, so that is not required. So now we can just continue. What are we now going to show? Our separately disclosable items. The first two being our dividend income and our interest income of 68,000 Rand. Dividend received, 10,000 Rand. Interest received, 68,000. Guys, and you have to split it. Don't show me 78,000. You have to split it because the nature of the income is different. Dividend income is different from interest income. So I need to show, the difference needs to be shown. Then interest paid. Let's have a look here. Interest on the long-term loan was 30,000 Rand. Interest on the long-term loan was 30,000 Rand. But what about our interest on our debentures? That is 11% on 40,000 Rand. So what do we have to do with that one? Now, is that our interest paid? 5,500 Rand equals that interest. If you go to your second last bullet point in your question, they say included in operating expenses are, and here they've told us that the debenture interest for the year was actually 5,500 Rand. So that is the reason why we had added 5,500 to the 30,000 to get to the total interest of 35,500. Now, tax paid. In order to determine what our tax paid was, well, let's have a look what was our outstanding balances to the receiver of revenue. There was our opening balance of 8,000. There is our closing balance of 12,000, but they never gave us the tax charge for the year. The only thing that they've told us was here in the last bullet point, company tax is 28% and wear and tear is equal to depreciation. That means that we have to do a small calculation. We said that our profit before tax was 295,000. There we've calculated that, 295,000. Included in that profit before tax was dividend income, dividends received of 10,000 Rand. There, dividends received of 10,000 Rand. By now you know that dividend income is not subject to normal income tax, so therefore I have to remove that dividend income out of my profit before tax for tax calculation purposes. So our taxable income was 285,000 Rand. 285,000 Rand multiplied by 28% will give us our tax charge for the year, which was 79,800 Rand. 79,800, and there's our tax charge, 79,800. So now by balancing off this account, we will see that we have paid the receiver of revenue 75,800 rand. Oops. Tax paid 75,800. Now we can finish off our cash flow from operating activities, 104,002,000. Guys, we have already completed this whole section. We've dealt with all these items. All we can do now is to add it all up, and you'll see that there was a net cash outflow of 1,011,000 pertaining to investment activities. Now cash flow from financing activities. Just see, long-term loans. What was our opening balance on our long-term loans? Was 300,000, and our closing balance was in actual fact 160,000. It is 160,000, and there was the 300,000. In the question, they actually give us some information about long-term loans. Long-term borrowings of 200,000 rand was repaid during the year. Going back here, a repayment, that's the debit entry there, credit bank, I debit long-term loans, 200,000, and then it means if once I've balanced off this account, it means that I must have received additional loan finance from the bank of 60,000 rand. So in our statement of cash flow, under our financing activities, payment of long-term borrowings 200,000, proceeds from long-term borrowings, so new long-term borrowings received from the bank 60,000. Okay, now let's see what they say about ordinary shares. On 1 January 2015, 100,000 ordinary shares were offered to the public. Applications for 80,000 shares were received from the public. The underwriters were Yellow Bank, so there's an underwriter involved. So how many shares would have been issued? 100,000 shares. The underwriters are actually charging a 5% commission on the total issue price. The shares were issued on 1 March 2015. Share expenses of 7,000 were paid together with a commission of 13,000. Well, there they give you the commission of 13,000. So what is our total share issue cost? 20,000 on 15 March. The company's policy is to write off any expenses relating to the share issue against the stated capital account. So that means that against that account, this amount of share issue costs have been written off. So the movement was 851,300 opposed to the previous year's 610,000, but the total share issue cost was 20,000 rand, the 13 plus the 17. So the balance would have been 871,300 opposed to 610,000 if it wasn't for that 20,000. So that means that the proceeds, the gross proceeds from the shares issued, 261,300. Share issue costs must be shown as a cash outflow on its own line of 20,000, which equals our 13,000 plus the 7,000. Then they also told us that certain preference shares have been bought back during the year. A portion of the 6% non-cumulative preference shares were bought back in April. If you look at your cumulative preference shares, there you can see clearly 10,000 rand. They don't tell you that there was any premium involved in this buyback, so therefore you can assume that it was only a cash outflow of 10,000. Okay, so now our cash and cash equivalents in the beginning and at the end of the year, that's the easiest part of the cash flow statement. Beginning of the year 4,000, closing balance 124,500, so clearly there was 120,500 rand increase in our cash balance for the year. If I go back to my cash flow statement, make sure that it always balances 104,200 less 101,100 plus 91,300 equals 120,500. Let's have a look at the story. We have generated surplus cash from operating activities of more than R1,000,000, but we've used pretty much most of that to put into investing activities. There was a little bit of money that we've generated out of financing activities, which also contributed to this investing activities. It looks, but it's only 90,000, eh? Only 91,000, and we've used our previous cash resources of 120,000. So roughly speaking, there was 200,000 that came out of excess funds that we had available in order to fund this. So we've used around about 800 to 840,000 Rand from our operating activity surplus cash in order to fund our investment activities. Now, it's a judgment call. Was that too much? Don't know. It all depends on the type of products that the company is selling. It all depends on the market share that the company has for the products that it has in the market. It depends on a lot of stuff. But you can clearly see that most of the investment activities was funded by cash surpluses, which they've generated out of their normal operating activities.